What kind of sort of recession is this?
Well, as you know, there's a good chance second quarter GDP will print negative for a second quarter in a row in Q2. As you kind of break down the data with job growth so strong, with what we continue to expect to be a positive consumer spending number in this week's report, it doesn't feel like a normal break into what we would call a recession. And I think we should recognize that about the first half. But at the same time, we should recognize the momentum loss that we had at mid-year. We're going to probably print a second negative consumption number in a row this week for June. As you've noted, the survey data for July, the flash PMIs were ugly. We're not just seeing that in the U.S., we're seeing it elsewhere, and claims are rising. So what feels like a technical event as we move through the first half of the year could easily turn into a real recession event as we go through the next couple of months.
In your spreadsheet, you've got a one-off on exports this quarter. Is it export growth to the rescue?
There is some support there, particularly as we see China and Asia lifting after what was a big second quarter set of lockdowns. But with the dollar rising and with Europe very much in the crosshairs of a recession right now, I would not be counting on exports saving us here. I think the saving grace has to be the business sector bending, not breaking in the face of the drags that we're seeing. Also, inflation coming off in the summer with gasoline prices starting to move lower.
Bruce, I'm looking at certain data points. You're looking at the same ones. Claims are higher the last few weeks. The PMI last week was really bad. We're starting to see this show up in housing. Yep. Bruce, I'm trying to work out which part of this is desirable, the intended consequence of what the central bank is trying to do, and which part of it is undesirable.
Well, I don't think the movement towards softer growth is undesirable on the part of the Fed. That's what they want. They want to slow the economy. They want to take out the demand component of inflation. And then they're hoping that with the moderation of some of the drags gets you back to something more acceptable. However, and I think this is really what's behind your question, the momentum loss there, the idea that layoffs are starting to rise, that's starting to push together a dynamic which traditionally has been recession. And recessions, we should understand in U.S. context, is a breaking. It's a move up in unemployment rates of 2% or more. That's the risk here, is that we're letting something take hold here that's going to give us a much sharper move than anything like what you might characterize the first half of the year as looking like.
Embedded in John's question, Bruce, is the fight that is articulated in an article on Bloomberg. The houses of Morgan divided, Morgan Stanley disagreeing with your own JPMorgan on when the Fed is going to reverse course, pause, and then start cutting rates after raising rates. At what point is the softening that we're seeing in data now reflective of a Fed that will be able to backtrack as soon as next year?
Well, I actually think it's far sooner than next year. We're looking for 75 basis points this week. We're looking for more open-ended guidance. I don't think they're going to commit to a size of a move at the September meeting. September's a tough call. I think we probably still do get a 50 at the September meeting. But beyond that, if we're seeing the economy really soften, job growth slow towards zero, I don't think the Fed's going to continue to be tightening here at an aggressive pace. We've got them pausing at about 350. We don't have them easing at this point because we don't have a real recession call in our forecast. But I think it's about the economy. If the economy starts to slow, given that the Fed gets rates into a modestly neutral stance, the equation changes at the Fed. It's not there today with a 175 level of rates and an economy that's still generating over 400,000 jobs a month. But it will be there in 3 or 4 months if we're right.
Bruce, what's enough to cause the Fed to take a step back? I mean, is it an unemployment rate at 4.5%? Is it inflation coming down to 5% from 9.1%? How far do we have to see progress, and I put this in quotes, when it comes to the deterioration in momentum does the Fed have to see before perhaps taking a break?
I think the short answer to that is the Fed needs to have a policy stance, a trajectory on inflation, and dynamics on growth that gives them comfort that in a year to year and a half's time, inflation is going to be below 3%. 175 on payrolls and the job growth we're seeing now is not there. 3 or 4 months from now, if payroll growth is down to 100,000 and the run rate on inflation with energy prices off is moving more into the 0.3% per monthly base, we think you could easily be in that zone.
Bruce, your update, please, on emerging markets. The currencies give way. I am told conversation after conversation, this time is different. All my radar's up.
Well, I think the currencies give way creates more risk here, especially since we're not going to see the relief on central bank policy. I think where this time is different is in the larger EM economies, and there is certainly a significant problem in low-income economies facing problems with food security and debt dynamics. But in the larger EM economies, you just don't have the debt overhangs, you don't have the current account imbalances, and you have policymakers that have been willing to continue to use fiscal policy. So growth is slowing. EM is certainly a threat if the US and Europe go into recession, and we shouldn't lose sight of the European recession story. But we don't think there's a systemic magnifying effect through credit, which is often the case when you see some of these dynamics take place in EM.
Bruce, where is the leverage right now? Can we finish there? Because whenever we talk about this recession story, you've acknowledged the risks in America, you've acknowledged the risks in Europe, in EM, yet we keep hearing the same thing, that consumer balance sheets are strong, corporate balance sheets are strong. Where do you think the leverage is going to show up?
Well, that's the interesting question, is are we going to see the dynamic on growth, which still has a healthy private sector, sort of cushion here? Is that going to get magnified by credit? It certainly isn't happening yet, but there's certainly signs of stress building. And, I think there's always the underlying point here. When you're raising interest rates and slowing growth, you can be surprised at where something shows up that doesn't seem to be a big story. I would worry about European banks here in an environment in which we're seeing, I think, more sharp slowdown in growth, and we're just getting the ECB going. I'd worry that some of the smaller EM economies show more tendency to spill over in ways we're not expecting from a geopolitical point of view and from a credit market point of view. There are things there, but I'll tell you for sure, I always am surprised where these things show up, but I think we shouldn't lose sight of the context that this is an environment where that's a likely outcome.